Good afternoon, ladies and gentlemen. Good morning or good evening, depending on where you are in the world. And a very warm welcome to this Scope webinar, which we've entitled Italian Banks Have Significant Room to Optimize Their Capital Structures. My name is Keith Mullin, and it's my pleasure to guide you through the session today. This topic was originally the subject of a report that Scope published on the 15th of April. And as an added service to the market, we thought it would be a very good idea to take this into a webinar format to give you the chance to hear what we have to say and to ask questions. Now, I'm absolutely delighted to be joined today by Marco Troiano, who is co-head of financial institutions at Scope Ratings, who in a second will take you through a short presentation. Now, as you will hopefully be able to see on the platform, there is a questions function. So please feel free. In fact, I would encourage you to type questions into the question box as we go along. Once Marco has finished his initial comments, we'll move straight to Q&A. We have a presentation, so I'm absolutely delighted now to hand the floor over to you, Marco. Welcome, good to see you, and the floor is yours.
Hi, good afternoon, Keith, and thank you for the nice introduction. Good afternoon, everyone. I'm a member of the financial institution team at Scope and the author of this report, together with my colleague Alessandro Boratti. The idea today is really to quickly take you through key messages regarding Italian banks' capital and our findings based on analysis of data from a couple handful of banks, major ones in Italy. Perhaps before we start, just a little bit of a reminder. I know that looking at the list of attendance, some of you will definitely not need this, but might be useful for other ones. You know that banks are subject to strict capital requirements, Basel III, transposed in Europe through the Capital Requirements Directive and the Capital Requirements Regulation. They're subject to a minimum of 8% of risk-weighted assets in total capital, and there are under Pillar 1, and there are requirements around the composition of this capital. 4.5% of risk-weighted assets at minimum has to be composed of CET1, and 6% has to be composed of Tier 1 instruments, so base equity plus additional Tier 1. They're also subject to Pillar 2 requirements, which from this year can be met with AT1s and Tier 2 securities as well as CET1, basically on the same proportions as the Pillar 1 requirement. And they're finally obliged to comply with capital buffers, so capital conservation buffer, systemic buffer, countercyclical buffer, which have to be met with CET1 capital. This is essentially the post-Great Financial Crisis framework, capital framework for European banks in very broad term, which means that assuming the banks do go ahead and fully optimize their capital stack, they have what are called in jargon buckets of 1.5% of risk-weighted assets to be filled with AT1 and 2% of risk-weighted assets to be filled with Tier 2 securities. And this is really a minimum. Normally these numbers are higher, as they also include, as I mentioned before, some of the Pillar 2 requirement, which can be filled with capital securities. So when we look at the situation of European banks and Italian banks in particular with respect to capital in 2020, we generally see a very good situation. Capital has gone up over the past 10 years, as you can see on the right-hand side of this slide. This increase was obviously driven by regulators asking more and more in terms of the different types of buffers. And as you can see, even in 2020, capital ratios have gone up. This particular chart refers to the CET1 ratio. On the left-hand side, instead, you do have a different type of chart which shows the CET1 ratio of the different Italian banks vis-a-vis their CET1 requirement, and also in orange a dot which shows the buffer to the CET1 requirement which is measured on the right-hand scale. As you can see, the 10 Italian banks we looked, from the stronger to the weakest bank on the right hand side, actually have quite decent buffers to capital, well above what was considered normal or desirable in recent years. So the situation looks quite good for a year which has been so troubled from an economical perspective. Now, if we look at why, in the recent year, in 2020 especially, the buffers have increased, we can identify a few trends really. First of all, obviously, organic accumulation, earnings. Earnings this year have not been stellar. There has been, for most banks, a decline compared to 2019. Obviously, the banks had to take a lot of provisions due to COVID, although these were mostly generic provisions. But there has been some profit left for retention, and this has helped banks build up the capital. The dividend ban from the ECB has also helped this dynamic. It's basically close to 100% of the profit was retained in the sector. And looking at the denominator of this ratio, the risk-weighted assets have generally behaved quite well. So it was a year where loan books grew, partly due to the higher liquidity preference from corporate customers. But this has not resulted in an explosion in risk-weighted assets, because on the new production, the risk-weighted asset intensity was actually quite low. And this was due to in large part, I would say, to the public guarantee schemes, but also to the introduction of some regulatory changes around SMEs. And finally, I would point out some regulatory changes around the composition of the Pillar 2 requirement, in particular the early application of Article 104. Which for the first time last year allowed banks to actually use capital securities to comply with the Pillar 2 requirement. Now, when we move from the monodimensional, CET1 angle to a slightly more complex way of looking at bank capital, which takes into account of the different thresholds with which banks have to comply in terms of CET1, but also Tier 1 and total capital ratios. We see a similar picture, but we note that there hasn't, first of all, that the buffers to the minimum requirement are reduced compared to the previous chart. And this is essentially driven by the fact that Italian banks have not fully taken advantage of the possibility to issue capital securities, in particular additional Tier 1 securities. As you can see on the right-hand side of these slides, all the capital ratios have gone up in recent years, but the key driver for the increase is really the blue line, which goes up, and the orange line is almost juxtaposed to the first one, which means that there is very little Tier 1 instruments building the capital stacks of this sector. Now, bear in mind that these are medians, so they might not fully reflect the fact that a couple of banks, for example, Intesa, Unicredit, are actually quite placed in terms of making use of the AT1 and Tier 2 buckets. But for the majority of the other banks sampled, that is definitely the case, and we'll see it in a second. So this slide actually intends to, it's very small, and I apologize for that, but gives you a summary of the build-up of the capital requirements for the 10 banks that we've examined. So going back to the initial framework I've described at the very beginning of this presentation, you can see it divided between Pillar 1, Pillar 2, and buffer requirements. And at the very end, you can see the estimated size of the additional Tier 1 bucket and Tier 2 buckets for each individual bank. And you can see at the beginning of this presentation, I mentioned that at the very minimum, banks would have a bucket of 1.5% for the AT1s and 2% for the Tier 2s. You can see that actually the buffers tend to be higher for all of the banks on the slide, because all of the banks has at least a positive Pillar 2 requirement. and that generally speaking, the combination of the two buckets is well above 4% of risk-weighted assets. Slightly, I think the smaller one was Credem when we looked at it, just below 4%. Moving on, I've actually put there some estimate of the surplus and shortfall in terms of AT1 and Tier 2s for each individual bank. We've calculated this based on the amount of AT1 and Tier 2s outstanding at the end of December 2020. Things might have changed marginally since, but the idea is to give you a big picture here. The only two banks that had a surplus in terms of AT1s of the 10 sampled were UniCredit and Intesa, while 8 banks out of 10 actually had a shortfall in terms of AT1s. And in terms of Tier 2, the situation is slightly more mixed. So you have, I would say, half of the sample that has a surplus, half of the sample which has a deficit in terms of compliance with the Tier 2 buckets. Now, why is this important? I mean, you don't need necessarily to comply with this requirement using capital securities. And in fact, what happens with Italian banks is that when they don't comply with the full capital requirements using capital securities, they actually do it using CET1 capital. So they have enough capital to still be compliant with the requirement, but they do it in a probably more expensive way than would otherwise be the case if they were making full use of the capital instruments. We've also calculated that all in all, the shortfall on the 10 banks sampled is around 4 billion. 1 billion of that is actually by Monte Paschi, and the vast majority, I would say, is on the AT1s. So to close off my introduction, my key takeaways. So we've measured the shortfall in terms of AT1s of 3.7 billion and in terms of Tier 2 of 380 million for 10 Italian banks. We think that the environment and the credit situation of Italian banks today is more conducive than in the past with respect to potential issuance of these securities. And we actually expect that banks, second-tier banks especially, will go on and issue more AT1 and Tier 2s going forward. Now, this could, the proceeds could be used in several ways, but we've mostly highlighted 2 of them. So if they just go out and issue capital securities, that would reinforce their capital stack quite significantly, therefore increasing the minimum buffer to requirements, and that will be good news from a credit perspective, and would also be very reassuring from a supervisory point of view, including in terms of compliance with MREL. Alternatively, we think that banks could also decide to issue AT1 and Tier 2 securities and in short order then proceed to distribute higher dividends or action some share buybacks, i.e. replace CET1 capital with AT1s and Tier 2 securities, so just an optimization exercise. Now, this second scenario is less credit positive in the sense that you're replacing higher quality capital with lower quality capital, and generally, as a rating agency, we would look at that more negatively. However, given the amount of excess capital that we think that there is at the moment in the sector, that will probably not be a major concern. And in fact, it could actually translate in a slightly more sustainable equity story for some of these banks we rate. One of the key concerns with respect to banks is the lack of profitability and difficulty that they have, returning their cost, clearing the cost of equity, essentially. So if they find ways to reduce the equity base or boost the profitability of the bank by reducing the cost of compliance with capital instruments, that could actually offset the lower for higher quality capital substitution. My idea is to stop here and to open up for questions. You have a question pane on the right-hand side, and I'll be happy to discuss with you the topic.
Very good. Thank you very much indeed, Marco, for those comments. So please do ask your questions in the questions box now. And as Marco says, we'll do our best to answer them. Marco, while we're waiting for the questions to roll in, hopefully, let me ask you something here. On the basis that you mentioned that Italian banks have made some effort and progress in cleaning up their balance sheets since the global financial crisis, and given the fact that the AT1 market there was a slight volatility in the market just when COVID hit, along with everything else. Generally speaking, the execution, you can get good execution in AT1. The banks are in better shape. Why haven't Italian banks made better use of AT1s, do you think?
So to me, it's a question of timing. Obviously, markets were very difficult this year to come to market with high-risk instruments. I mean, these, let's just remind everyone, these are deeply subordinated instruments, and they come with high coupons. And the investor base is quite limited, especially when the instruments end up in deep non-investment grade. Now, I think if you take a slightly longer term view, Italian banks have been busy for the best part of the past decade with the legacy NPL burden for the crisis, and it was very difficult, for them to go to investors and market high-risk securities where they were in the middle of this, cleanup that really started, I would say, in 2015, after the asset quality review. By the end of 2019, 2018, for the larger banks, 2019 for the second-tier bank, it became clear that the asset quality story, the asset quality cycle was over. And in fact, some of the banks managed to issue AT1s, Intesa, Unicredit in particular. And then, it seemed that the second-tier bank could also come to the market in 2020, but here we are, locked up in our rooms, and it's not again. It has not been a lucky year for going to the market with this high level of uncertainty. And it's probably in the very short term it still is. We still have a number of issues on the table, including the moratoria that have to clear up probably before investors feel more comfortable, and banks think that they can go and issue at reasonable cost.
Yes, indeed. It does beg, I guess, a follow-on question, which is we've seen a lot of distress over the past year across Europe, not just in Italy, across Europe, driven by COVID, economic recession, clearly, slightly cushioned by fiscal and monetary stimulus. We've all seen the numbers here, but here's the question: it's always a $6 million question when you go to Italian banks, which is, which I wonder, does this account for the Italian banks' maybe lack of preparedness to issue AT1? Which is, how do we know there's not an asset quality crisis around the corner in Italy?
Well, no one knows the future, obviously, but I mean, my view is that this is a very different crisis from the past one. So, when I think back at what happened in 2012, especially during the sovereign crisis, what you had was a debt deflationary environment. Banks actually closed the taps and all but stopped lending, and this turned a lot of customers which might actually been viable into non-viable. I think it was a very unfortunate combination of the sovereign crisis, so funding stress on the banks, and also the Basel III regulations coming in at the very wrong time from a cyclical point of view, so forcing banks to retain more and more capital. So banks were really constrained on a capital, on a liquidity front, and they stopped lending. What we have seen in this particular environment was a very pragmatic approach from the central bank that kept banks very liquid, a very pragmatic approach from the supervisors, which gave banks flexibility on the capital front. And we haven't seen that sort of behavior of credit crunch on the real economy. So in a way, I don't think we're going to have that long tail in terms of asset quality. Obviously, it's a terrible recession and businesses are struggling, but to me it looks more like a more normal cycle. And by the looks of 2020, banks, yes, they took significant provisions, but for the most part they were absorbed out of ordinary profitability. And they're probably going to take more in 2021, when, especially as the moratoria regime expires. But the base case is that this is not going to be, driving capital losses. Surely not to an extent where their solvency is called into question. They have some profitability buffers, as we've seen. They have very strong capital buffers at the moment. So I don't actually expect banks to go into that leveraging mode.
Absolutely. And Marco, the experience to date seems to suggest that as countries come out of moratoria, customers, the resumption in debt payments seems to be normalizing. Is that a fair assessment, or do you think that we still have some time before we can actually make conclusions here?
No, I think it's too early to have a definitive view here. The first signs are encouraging, especially from other countries. We've seen the moratoria regimes expiring in the UK, for example, and generally in Spain and other countries in Europe, and the outcome has been quite benign. You had a number of customers obviously not resuming payments, but that's to be expected. In Italy, we're a bit behind in the sense that the moratoria regimes were extended a couple of times. So I think we have to wait a few more months, unless they're renewed again. We have to wait a few more months to see what the actual outcome is. We have partial data at the end of December of default rates of customers that were under moratoria and have exited the moratoria regime. This data is very encouraging, but I would caution that there is probably some bias in this sample, because in the end, the moratoria regime in Italy, in order to exit essentially these moratoria programs, in large part it was a voluntary choice by the debtors. So there could be an element of self-selection there that skews the picture. So you can't really extrapolate from the 1/3 of moratoria or 1/4 of moratoria that have expired as of December to the entire sample. So I think we need to wait a few more months, and then I think what will also be really key to the asset quality cycle is the speed at which the fiscal support is lifted. This has been a year of great deficit spending. 2021 will be the same. We know that there is the European recovery plan and Next Generation EU funds being deployed. Now the question is, at what point the fiscal stance turns from being a support to the economy to being more of a burden and headwind. My expectation is that actually the lifting will be very controlled. Again, even from a fiscal policy perspective, the environment looks very different from what it has been in the past crisis. I've barely heard the word austerity, despite the level of deficit in Italy, which is really high.
Mm-hmm. Absolutely. So I've got a question that I will ask you in a second, but those of you still dialed in, please do ask questions. Being very shy today. I'm sure there are things you can ask Marco about his presentation or about Italian Bank's capital. So I've got one question, and if there are no more questions, we'll close the session. So please feel free. The clock is ticking. Marco, just thinking back to what you were saying in your presentation, it was obviously about Italian banks, and that was the focus of the study for this piece of research in this webinar. But do the main takeaways apply to other markets in Europe as well, do you think?
Yes, I would say partly, in the sense that the big difference is that in other markets, banks had made more use of AT1s, especially in Central Northern Europe. So I think you could have less room there. But the general environment is quite conducive to this kind of issuance, because you have low yield, investors very hungry for yield, and I would say I would extend to the whole European banking space the considerations that I've made around the risk environment, which banks have essentially behaved very well in this crisis. This has been what I call the acid test for the de-risking post-financial crisis. I mean, the new regulation works. The Basel III implementation, by and large, there are small fixes that are needed, but it works. Banks have less risk, they have the capital, and they didn't turn into a pro-cyclical element in this particular crisis. So they have, they've improved on the risk profile. So you might see some more banks, especially in peripheral Europe, I would say, now feeling more ready, and at the same time investors feeling more ready to actually buy this type of securities.
Absolutely. Okay, thank you very much. So Marco, it appears there are no more questions, which suggests that your presentation had 100% hit rates in terms of information, disclosure and flow. And so if there are no more questions, we'll close in 1 minute or less. So no, that's it. So Marco, thank you so much for the presentation and for answering the questions. Thank you very much for dialing in and staying with us. As you may have seen, we are actually upping the pace of our webinar program because we think it's just a very useful way of engaging with you as market participants, and it gives us a good sense of what you're thinking as well. So stay tuned for more sessions of this nature. And on that note, actually, I think, Marco, we may literally have just got, no, that wasn't a question, it was just an observation. Thank you so much indeed, and we'll be in touch for our next session soon. Thank you, and enjoy.
Thank you very much, Pete.
Okay, thanks. Bye-bye.
Good afternoon. Bye.